When we perform financial analysis, we analyze the income statement, balance sheets, and cash flows, right? Of all the items that we look into, one jumps out, and that is earnings per share or the EPS. EPS is primarily used in valuation ratios like the PE ratio in order to identify whether the company is worth investing or not. In fact, there are two types of EPS, the basic EPS and the diluted EPS. Hi all, my name is Dheeraj from WallStreetMojo.com, and in this video we'll learn all about basic EPS, how it is calculated and how it is used in financial analysis. So let's get started. So in order to understand the basic EPS, let's look at this example. Here we have sales as 20,000, cost of goods sold 8,000, gross profit as 12,000, and then there are other expenses in between, selling, general and admin expenses, depreciation, amortization, etc. So all in all, I want you to look at this net income that comes out to be $3,400. So what does this signify? So let's assume that there are 100 shares, okay, of the overall company. So this 100 shares basically represent the overall 100% ownership of the company, right? So if there were only 100 shares, that would mean 100% ownership. If there were 1,000 shares, that 1,000 shares would have represented 100% ownership, okay? So when we look at the basic EPS or the basic earnings per share, we are trying to understand how much is the net income on a per share basis. Okay, so if there were 100 shares, how much is the income on a per share basis? That will be 3,400 divided by 100 shares, right? So let me just put the basic EPS formula first. That will be equal to net income divided by your number of shares. All right, so let's calculate the basic EPS. This will be equal to $3,400 divided by 100. So this comes out to be $34. So now that you have an intuitive understanding of what basic EPS means, let's now figure out how it is actually calculated in a practical world. So this formula, this basic EPS formula gets a makeover. It's a little different from what we have just discussed. So the formula goes like this. It is net income minus preferred dividends divided by number of common shares. Okay, so there are two things which are kind of new here: preferred dividends and number of common shares. So let's discuss the denominator first. So number of shares which we discussed here, 100 shares. So these are nothing but the common shares we are talking about. All right, common shares, ordinary shares, or the number of shares outstanding, these are all one and the same thing. Okay, then there's another class of shares that's called as a preferred shares or preferred stocks. So preferred stocks are those stocks that are eligible for dividends every year at a certain rate. So whatever your profit is, that doesn't matter. Preferred shareholders will get preferred dividends each year at a certain rate. All right, so in this case, that's why net income is reduced by preferred dividends, because that's owned by a different class of shareholders. All right, so once the amount that is due to the preferred shareholders is given, whatever is left over is for the common shareholders, and that's why this basic EPS is slightly different in terms of total calculations. So let's assume that this preferred dividends in our case is, let's say, $1,000. Okay, so how much will be your basic EPS? So the basic EPS will be equal to your $3,400 minus $1,000 divided by 100 shares, right? So that comes out to be $24 per share. So that's how practically you can calculate basic EPS. All right, so in the context of our discussion of basic EPS, it is very important to understand the capital structure of the company. So what do I mean by this is that there are two types of capital structures. The one which we just discussed is called as a simple capital structure, and there we had the common shares and then we also had the preferred shares, right? Now, these are the only two things which we had, and we call that as a simple capital structure. The second one is called as a complex capital structure. In the complex capital structure, we do have the common shares and the preferred shares, but we will also find things like stock options, think of convertible debts, etc. So what happens because of the presence of these stock options and convertible debts? It basically affects the number of shares, okay? And how does it do that? Think of stock options. Stock options are options that are given to the employees, right? And after the vesting period, they can convert them into shares by exercising those, right? So when they exercise those shares, the total number of shares outstanding will increase, right? Now again, think of convertible debts. Convertible debts are those kind of debts which can convert into normal shares at a specific stock price. So if the stock price touches that number, your convertible debt will get converted into shares. So what will happen? It will affect the total number of shares. So this will essentially do nothing but increase your number of shares, right? And once you calculate the earnings per share after taking into account all of these as well, then what we get is the diluted EPS, okay? Diluted earnings per share. So the first we calculated was the basic EPS. But when we also look into the fact that there are stock options, convertible debts, warrants that may affect or increase the number of shares, what we get essentially is the diluted EPS. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future videos, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on finance and accounting topics regularly. So if you have not subscribed to our channel yet, then please do so by clicking on the subscribe button so that you can get the notification as soon as we release the new video. Thanks for watching. Have a nice day.